Hello everyone, Dave Landry here from DaveLandry.com, and this is Trading Simplified, episode 29. Wow, time is flying. So what are we going to talk about? Well, I want to continue my discussion on the trading rules. So we're up to part 4 on that. And the reason it's taken so long, one, of course, because we're doing these bear market updates in between. But the other reason is that each one of these can be expanded into a complete seminar in and of itself, or a webinar, and on a lot of them I have. In fact, what I'm going to do is I'm going to continue on with these in more details in upcoming shows. The other thing we obviously want to continue to talk about is the bear market update, and I don't want to make it look like, okay, let me just tell you what I think and then go away. Show you what I'm seeing and why, and that way you can take these same tools and use them next time, just in case I get hit by a beer truck, or I've been joking lately, my wife kills me while in quarantine. Housekeeping, I do take requests. It's going to take me a little while to catch up to those requests now, but please do send them in. And worst case scenario, if it's not a quick answer, something that requires a lot of thought, I can cover it in my Weekend Charts show, which I do on Thursday. I do a webinar on Thursday, and that's a little bit more open-ended, and I have somewhat unlimited time with that. If you need to reach me, DaveLandry.com/contact. You can also download my slides from DaveLandry.com/StockCharts. Put your information in, and then you'll receive my slides, I should say. Also, you'll get a free market timing course, which covers a lot of the concepts we've been talking about lately here. And also, in addition to the slides from this presentation, the slides from all the other presentations, which have all the setups and the rules in them. Speaking of bear market updates, you can go to my website. I added a menu item up there for bear market updates, and just click on that and you'll get the latest articles and webinars. Now, whenever you look at a market, what I like to do is look at the net price movement. So if we're looking at the S&P 500, you could see that we've obviously gone higher for about the last month or so. But the thing that I look at, and as should you, is where are we now, and just kind of look back to your left. And by the way, if you find a broker that lets you trade off the left side of the chart, let me know. And see how far you can draw a line to the left and see how many bars you can intersect, and look at the net price movement. So if we go back to around April 14th, you could see we were relatively unchanged from that level depending on the time of day. So several weeks of sideways trading, even though we've been in this big retrace as of late. So you could argue that the market is losing a little steam in here. Now, along those lines, let's take a look at everybody's darling real quick, and this is Zoom. And Zoom has done fantastic this year. In fact, it's up about 100% since the beginning of the year. But notice in more recent times, looking back to the left, you could see that it hasn't made a whole lot of progress in roughly 1 month. So it is losing a little bit of steam. And you could also see that if you connect the tops, it has a bit of a double top or the possible makings of an inverted cup and handle. So the point I'm trying to make is, even though something was strong for a while, it doesn't mean that obviously it's going to continue to be strong. You need to pay attention to when that market may be losing a little bit of steam. And by the way, what will likely happen when this bear market does end, the prior leaders will likely become laggards. And what happens is, let's take, for instance, Zoom and other possible communication stocks like this, biotech and selected healthcare. Those stocks will actually become a source of funds, and the value players will look to play the stocks that are coming off of lower levels. And believe it or not, some of those value stocks, so to speak, can turn into momentum stocks. And as momentum players looking to trade these transitional patterns, such as bow ties, we should be able to participate in those moves when they occur. Now, one thing I've been talking about quite a bit lately is Landry Light. Landry Light, to the downside, is simply that the highs are less than the moving average, and to the upside, the lows are greater than the moving average. And by accident, I discovered the 50-week simple moving average by looking at it and seeing whether or not you have downside Landry Light or upside Landry Light. So red when it's below the moving average and green when it's above the moving average. As a general statement, that will help to keep you on the right side of the market. And what's kind of interesting is I'll come up with something like bow ties, and then I'll notice on the charts that something even simpler, like a 50-day simple moving average, can help to keep you on the right side of the market. We'll take a look at bow ties in 1 second. You'll see what I mean. But again, red when the highs are below the moving average, and green when the lows are above the moving average. And obviously, we have a little bit more red now. Now, the reason I'm showing you this on a blank chart with just the moving average is to show you that the concept is very, very simple. Although I did have an indicator programmed, as you can see in the bottom of this chart, and this will be available to you hopefully really soon through StockCharts. This is actually in the ACP platform, and I'm working with a programmer when as time allows to make sure we get you anything that I mentioned here. But anyway, when you see it in graphic form like this, and the indicator, by the way, just counts the number of days of Landry light. So my premise here is that bad things happen after bad things have been happening, and good things happen after good things have been happening. In other words, selling begets more selling, or red begets more red, and green begets more green. Now, I haven't tried to quantify this, and maybe I don't need to, but I think just kind of as a general observation, you can see when we have these big bear markets, it stays red for a while, and then it stays red for quite a while longer. And then in these nice little bull trends we have, it stays mostly green, and you have a little red here and there. And of course, after it's red for a while, it begins to worsen. I often joke it's often darkest right before it gets more dark. And then just continuing along that line of reasoning, you can see we had some green and then more green, a little red here and there, but for the most part, lots of green over the past 5 years or so. Did have a little bit of red in 2015, 2016, and that doesn't look like that big of a deal, but as a trend follower, that was a pretty big deal back then, and the market sold off fairly hard, and certainly had some really big whipsaws. If you stayed long through that, I think that was a bad idea. The market has rewarded bad behavior. That's one of the reoccurring themes that I often talk about. And anyway, it went green again, obviously, in 2016. Stayed green for a long, long time. We had a little bit of red. In other words, again, the highs are less than the moving average. And 2018, specifically November, December. And that was a very sizable spill. And I think if you held through that, once again, the market is a bad teacher, as I said ad nauseum. In fact, it was in the article that I showed at the beginning of this presentation. This gentleman, man on the street type of person, somebody I bumped into, said, "Man, I'm glad I held through December. I wish I would have bought more." And he said that in January. Well, the market has told him to hold on at any cost. Now, again, we had a little green back in early 2019, stayed green for a long, long time. In fact, all of 2019. And then now, obviously, we're dealing with a little bit of red. Now, again, I think the longer we stay red, the longer the chances are that we will continue to stay red. Now, here's the deal. I believe in taking things one day at a time. Now, let's take a look at the weekly bow tie signal. And we're just looking for, on a weekly basis, this is a major trend signal. When you see all three of these moving averages come together and then begin to spread out from uptrend proper order, meaning the 10 is greater than the 20 and the 20 is greater than the 30, 20 and 30 being exponential moving averages, the 10 being a simple moving average. I just really like the way the relationship between those moving averages pans out. I've played with every indicator in the world and every moving average in the world, and I just find that I really like the relationship between these, and it makes for a really good transitional setup, meaning that the trend is beginning to turn from uptrend to downtrend. Now, obviously, on a weekly basis, it takes a while to catch up, and sometimes a little lag is okay. Obviously, you would want to be out of this market long before this weekly signal triggers. And we actually had quite a few signals, even some weekly signals, other than this triggers we talked about in other presentations. But the reason I'm bringing this up again today is major bull and bear markets can occur, as you'll see in 1 second, after these signals. So if we take out 2700, that would give us a sell signal. And if we got above, let's say 2950 or so, that wouldn't be a buy signal based on this setup, but I would definitely say that the market's improving. And once you get above the moving averages, as I've said quite a bit, especially the exponential moving averages, they'll turn up quickly. The exponential moving averages will turn up the first day, or in this case, first week you close above them. So this signal could be negated fairly soon if we stay above 2950 or so. Now, I've beat the dead horse on this in prior presentations and over the last probably 15 years or so in the weekend charts, so I won't spend too much time on it, but I just want to show you major signals here right before major bear markets, and by major I mean coming off of all-time highs, and then major buy signals, as you can see, were at the beginning of some really nice up legs, and by major I mean 10-year or at least 5-year lows. In fact, in 2009 it was like a 13-year low. And then you can see the last couple of sell signals really didn't pan out to be that big of a deal if you're squinting your eyes and looking at this chart. But if you actually lived through those sell-offs, they were fairly substantial. And I remember the indices losing well into the double digits on those sell-offs. So it was fairly significant. So once again, we have another sell signal working in the S&P 500. So I think it pays to pay attention. Now, check back often. And as I often say, the signals will provide clues. If we slide in the piece and take out those lows we just talked about, I think the market could get uglier. Right now, we're consolidating, we're going sideways. So let's just see if that develops a range, and we'll look for possibly a breakdown from that range or possibly a breakdown above the range. Not that that will be a buy or sell in and of itself, but it'll certainly give us some structure to work around. And as usual, you want to take things one day at a time. I often quote Abraham Lincoln, who once said, the great thing about the future is it comes at you one day at a time. Now, as I often say, everything I do is setup driven. If I see a great long side setup, then I'll take it. I just have to be really careful about intuition, which is a line I stole from Market Wizards from Ed Sakota, versus intuition. And along the lines of intuition, I noticed this particular stock here, and I'm not going to make it an official mystery chart, but I was thinking this morning, should I have put this as an official setup in my trading service today? Should I have looked to buy it myself? And then I got to thinking about it. It's like, no, this really isn't that fantastic of a setup. I think it needs to pull back a little bit more, and if it does pull back a little bit more, then it might not look as good. So I'll know it when I see it. So it's possible, maybe next week I'll bring this up as a possible mystery chart. Now the mystery chart, which I borrowed from Dave Keller, is a chart where, for at least the way I look at a mystery chart, is it's something that I recommend as a buy or a sell short. And I show you the setup ahead of time, and then I walk you through what happens with it. The mystery charts did exceptionally well during the bull run, and they did really well during the initial slide in the overall market. And lately, they haven't done so well. Now, let's get back to the 12+1 trading rules. Last week, given the nature of the market and the nature of the market players right now, I thought it'd be a good time to jump ahead to number 13. And we'll spend some time on this one today. And we're going to spend a lot of time on these in coming weeks. Now, like I said last week, trading psychology is kind of like peeling an onion. The layers just unfold one little layer at a time, and it all dovetails nicely into a trader's journey, which is something we've talked about in the past. And when we go deeper into these subjects here, we're going to get deeper and deeper into that trader's journey. But starting off to the left, the trading thing looks pretty easy. You look at these charts and it's like, okay, well, all I need to do is I need to sell higher than I buy. And it's like, okay, well, that's pretty easy. And as I said a second ago, a lot of times the market will reward bad behavior. In the past, I've had clients, it's kind of interesting. One client came in and he was trading a more arcane type of methodology, or trying to trade it, I should say. And then the market began to roll over, and the market trend fit perfectly with his arcane methodology, and he really thought he had the Holy Grail. And as I've said before, he reached a point where he had made hundreds of thousands of dollars, and I was urging him to cash out and pay off his house. At least he have a place to live, and if he's that great, then rinse and repeat. And I've actually was up close and personal, as I've said quite a bit, with someone who turned a very small amount of money, about $5,000, into roughly $1 million. Unfortunately, he round tripped it, and same sort of thing I told him. There was another client where his first trade was on the short side. He came in 2007, late 2007, and all I could find for setups were on the short side. So he started shorting, and he absolutely fell in love with the short side. Unfortunately, when the market turned back up in 2009, he was still trying to short the market. Just like the person who was following the arcane methodology, he began fighting the trend. Now, fast forward to recently, you have these newly minted quarantine traders. And if you are in quarantine, as most of us are, and you just decided to start trading, then that's great. I'm glad to have you. I just would like you to go into it with eyes wide open. So the market kind of just melted up from the lows. And if you went in and bottom fished, and if you're just jumping in and out on the long side, you probably did really well because you have a tailwind, or as I've been saying lately, you've been having a hurricane behind your back. The problem comes in when conditions begin to change. One thing I was looking at this morning, I was looking at the longer term volatility on the S&P 500, and it kind of looks like that flattening of the virus curve, which hopefully continues to flatten, obviously. But the point I'm making there is the volatility is beginning to come off of this market, and the volatility might have been what really helped out these traders. I've known some people recently who have just jumped in and started day trading, and they're doing exceptionally well because the volatility is so big. They're just hopping in, buying, and flipping out a couple points higher. And believe me, it's not always that easy. And at some point, when conditions begin to change, whether you begin fighting the last war, whether that last war was an uptrend, and now all of a sudden the market's going down, or if you have accidentally stumbled across something to do with volatility, and that volatility is high, and then all of a sudden that volatility begins to wane, all of a sudden you're going to find out that maybe trading is not that hard, and you begin to wonder if it's just you. And believe me, it is not just you. As you begin to peel this trading psychology onion, you'll learn that we're just not made to trade. And one of the biggest secrets to trading, in fact, I do morning notes every morning. I recommend you do that. I call it, it's called Morning Pages. Julia Cameron popularized these. I tried doing them like 20 years ago, and it was fantastic. But for some reason, I just fell out of favor with it and stopped doing it. But every morning I wake up and I write 3 pages. And yesterday, and it was almost like I wrote it over and over like a mantra, I wrote, let the market come to me. Let the market come to me. Let the market come to me. And that's the secret. But if you are motivated and successful, and if you're watching an educational video like this, then you are motivated and successful. It's going to be a lot harder for you to let that market come to you. It's going to be harder for you to be patient. And I go a lot deeper into this, but one of the reasons, after talking with a psychiatrist about this, I had posed the question many of times, like, how come these people who are successful in life take such mediocre setups? And she emailed me one day and said, I have an answer for that, because in our profession, and if you're a lawyer or a doctor or automatic transmission mechanic, then it's hard for you to wait and wait and wait, because if you waited and waited and waited for the perfect client or the perfect car to fix, or whatever the case may be, then you'd be waiting a long time and you would eventually starve to death. But in trading, it's hard to do that. So as you begin to wrap your head around why we not made the trade, there's a lot of other psychology that begins to rear its ugly head. And of course, we tend to mentally monetize the money. I just went through a drawdown and hopefully I'm done with it, but we'll see. But I'm passing new car dealerships and I'm looking and thinking, like, had I not gone through that drawdown, I could have bought that shiny new car over there. So there's a whole lot of things that happen from a psychological standpoint. One of my epiphanies about 7 years ago was I was speaking in San Francisco at the TSAA-SF conference, and Denise Shaw was there, and she was talking about the fact that you cannot separate emotions from decisions. So all of these people out there just say, well, you've got to control your emotions. You've got to eliminate your emotions from trading. Well, I've had a hard time doing that, and I'm still real emotional, and it's like, well, what's wrong with me, okay? Well, she said, and a lot of the research comes from a person by the name of Damasio, but she was saying that every decision has an emotion attached. And I'll take that one step further. Every decision has a consequence attached. And that's actually on a neurology standpoint. Now, we could argue that we don't all have a shared psychology when it comes to trading. But I think that the psychology we have is more common than a lot of us may realize. But anyway, when it comes to neurology, we all pretty much have the same exact neurology. Our brains work a certain way. Now, we might have different genes that act a little bit differently, or we might have a little bit different chemical response. But for the most part, we have a shared neurology. So every time we go to make a decision, there is an emotion attached to that decision. One way that I wrap my head around it is to be cognizant of the decisions I make all day long. It's like I like drinking beer, but I also wake up at 4:55 a.m. every day. And if I have a couple of beers at night, I'm going to be a little groggy the next morning waking up for the market, okay? So I have to go through that thing in my head and say, is it worth it? And there's an emotion attached to that. And so again, if you want to wrap your head around how emotional we are from a neurology standpoint, I would encourage you to look at every decision you're making and feel those emotions. Now, the next thing you'll find in peeling this trading psychology and neurology onion is you'll have a bit of a self-discovery, as I've said quite a bit. Larry Williamson wrote a really good book on trading psychology. And each week I say I'm going to find the book. I keep forgetting the title of it. But anyway, one of the things he suggested doing was take a personality test. And I've said this quite a bit before. So I took the test and I scored like really low in agreeableness, almost like a 0. And I also scored like off the charts, like 100% in extroversion. So two really, really bad traits for a trader. And it's like, well, now I know why I struggle in trading and why I know why the lows are low and the highs are high. And that's because I have a very, very low agreeableness and I have a very high ego. When I told my wife and daughters about my agreeableness, and I'm like, can you believe that? And they're like, they looked at me like I pooed my pants, as I often joke, kind of like the look they give you if you just walk into Starbucks and say, I'd like a cup of coffee, you know? Before I knew how to order a cup of coffee, I had to have my teenage daughter go in there and help me. Anyway, there's a big self-discovery in all this. Taking a personality test would really, really help you. You need to be cognizant of your bad behaviors, and that comes through journaling. Really, really helps. And then not just your trading journal, but writing those 3 pages every day as recommended by Julia Cameron, or popularized by Julia Cameron, I should say. And you'll start realizing what you did and why you did what you did. One of the good news, which I was going to hold off on for a few weeks after we got deeper and deeper to trading psychology, but the good news is that you know what you're doing wrong, especially if you're willing to document those things. And of course, not just your actual trades in your trading journal, but document how you feel about the trades. Right before I began recording this, I'm a little aggravated because I've got a short that's going against me, and applying logic to the market, okay, which is part of the reason, going back in the onion, why we're not made to trade, because the markets often don't work on logic, although lately they have been, right? Zoom has gone up. Some of these pet-related companies have gone up because people are home with their pets. So lately the logic has worked, and that's one thing I woke up thinking about. It's like, well, the tricky thing about the markets is logic often doesn't work, but it works every now and then to teach you that it works. But anyway, in the journaling and the trading journal and getting your thoughts out every day, you become more and more cognizant of your bad behaviors. And the good news is you'll discover that you know what you're doing wrong. And I'd be willing to bet $100 if you don't know what you're doing wrong, provided you've been trading for a while, with a little noodling, we could probably figure out what you're doing wrong really quickly. So most of the time somebody comes to me and I'm like, how am I going to figure out what this guy or girl is doing wrong? And then most of the time I ask them and they tell me, and it's almost like the doctor joke. Well, don't do that. One case really sticks out in my mind, and I know I've told the story ad nauseum, but years ago in my trading service, the market was kind of chopping around a little bit, and we were keeping our head above the water. We weren't printing money or anything, but we were making a little bit of money. We had a few winners in the portfolio. And a client called me up, and he insisted that I look at his portfolio to tell him what he was doing wrong because my system wasn't working, and he went on and on. And so I said, all right, well, let's take a look at things. And so I went through all of his trades, and I took the ones out that were my direct recommendations, not that I'm the grand poobah or anything. And I took out, he had 20-something day trades in one particular stock. And so I called him back later that day and I said, okay, I have good news. You followed everything I recommended to the T, not that I'm the grand poobah again, and you actually made a few $100s. You didn't really print money, but I think you net on a small account, you were up about $300 or $400, which is better than the poke of the eye. However, you lost over $5,000 in these 20 day trades. And what he said next was kind of shocking to me. He's like, I know. Which it's like, so again, you know what you're doing wrong. Which brings us to our next point, commitment devices. And this is something that we could spend an entire presentation on in and of itself. Now, a commitment device is something that you will do to make a bad behavior hard or a good behavior easy. And ironically, the same gentleman, struggling a little bit with trading, as we all do, he basically comes in every day, hands his phone to his secretary, and has her change the password to his trading account. Now, that's a little extreme, but you have to do what you have to do to get it done. And in upcoming shows, I'm going to spend a lot of time talking about commitment devices. And then further into the onion, I think when the true enlightenment really comes is when you start doing brutally honest, process-oriented postmortems. By process-oriented, I mean you look at your trades and ask yourself, did you follow the process? And if you followed the process and you did everything right and still lost money, you have to be willing to accept that as something that comes with the territory. Okay, well, we're out of time. When we get back next week, or when I come back next week, we're going to get into all of this in a lot more detail. There's one thing I can leave you with, is that trading never becomes easy, but with time you will find that it comes a little easier, provided, of course, you're willing to do that brutally honest introspection, the postmortems, the journaling, and everything we talked about earlier. And again, we'll get into that in a lot more details. Everybody stay safe, stay sane, and may the trend be with you. Thanks for watching.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.